Good afternoon, everyone, and thanks for joining myself and Jos Herman today for our presentation on business owners. So first of all, I'm going to talk about a little infomercial about SSQ. We have now, we're the fourth largest insurance company in Canada, and we're the largest mutual company in Canada as well. Now that we merged as of July the 1st with Le Capital, we're very excited to be offering new products and this new company. We haven't come up with the logo yet. We'll be disclosing and announcing our new logo and our new name in the next few weeks. So thanks for joining us again today. We do appreciate your time. We know that it's an interesting year with COVID and working from home and doing the sessions, and we would have loved to see all of you live. But this is what we're doing Zoom meetings now to still get across the country our message about SSQ and help you in your business and help your business owners as well. So now we have over 20 billion in assets under management and 5 billion in gross premiums. So we're very excited about this, our merger. So if you have missed it, or if you hopefully been paying attention to some of the emails and my presentations I've been doing across Ontario, but our new simplified issue and guaranteed issue products that launched this year in June, we're very excited about how this is going. We have been able to insure many more Canadians and get their policies delivered within 1 hour. So if you haven't checked out our simplified issue or our guaranteed issue, reach out to myself or Sally, my inside, to learn more. So basically, in a nutshell, your policy, your clients can apply for the application, and from the time you send the application in to delivery of the policy, the clients sometimes, in some cases, have their policy delivered within 15 minutes. The client has their coverage and their policy in their hot little hands within an hour, and you're paid within 24 hours. Of course, if it's on the weekend, you'll get paid in the following business day. But even if you are meeting with your client either face-to-face or non-face-to-face, even on a Saturday at 11 o'clock at night, if you really, since you can't go very far right now with things shutting down, you can still meet with your clients on a Saturday night at 11 p.m. and your clients will have their policy issued before midnight. So they'll get their policy and they'll be covered even on a Saturday night at 11 o'clock p.m. So our hours, Monday to Friday, from 7 a.m. until 11 o'clock p.m. On Saturdays, I think it's from 5:30 until 11 p.m. And on Sundays from 7:30 until 11 o'clock p.m. So if you're seeing your clients or talking to your clients or non-face-to-face, you can still issue that policy, we can have it issued to the client within an hour. So it's very exciting. And not only that, but the premiums are, in some cases, 20 to 60% cheaper, so less expensive, and you get paid 25% more commission. So more commission, lower premiums, and the policy delivered very fast, within an hour. So I say, check it out. If you haven't looked at it yet, if you need some more information, reach out to Sally or myself, and we'll be happy to help you. We also, so back to the story on delivering those policies fast, our underwriting, what we're doing as of October the 1st, we're introducing a new style of underwriting. It's all electronic and it's smart underwriting, if you will. So the policies will be delivered much faster. They don't physically have to go to an underwriter. So it's under $1 million. The policy will be underwritten electronically and all according to stats and formulas, and you don't have a physical underwriter looking at it under $1 million. So what that means to you and your clients is it's a lot faster way to underwrite the policy and get that policy delivered much quicker. So stay tuned for more information on that. Jean-Francois Chalafaux is our CEO, and he'll be the new CEO for the new the new company. And the exciting thing is he's been appointed to the chair of the CHLI. So what that means to you is, and to us as an industry and insurance, is that having a CEO of an insurance company, it means that they'll be able to, CLHIA, sorry about that. And, but he will have a lot of input and be able to help guide our industry and get our clients what we need and us be our advocate for us here in the field. And I feel having Jean-Francois on that board of directors, it will certainly help us move forward as an industry. So we're really excited about that. So our session today is on business owners, and I will turn it over to Jos in a few minutes. But a lot of my brokers ask me how to prospect business owners, how to prospect new clients. And so we looked at some of the research, and how many clients or prospects own a small business? Well, in Canada, 98% of Canada's 1.2 million employers in 2018 were small business owners. So 98% of the businesses were small business owners. So an opportunity for you is they employ 70% of Canada's workforce. So it's an opportunity for you to get in front of those business owners and look for some opportunities and really dig down and do a proper needs analysis. It's, not just an insurance policy, or you can't just sell them a GIC. Maybe there's some better ways to service that client. So during Jos's presentation, she's going to give you some ideas and teach you the basics about how to approach these clients and what you need to know on the taxation part of it. And then I'm going to be doing some presentations afterwards on the corporate wealth note and how to use our illustration software, how to actually show clients and do a comparison between whole life or universal life, and I can help you with that. Some opportunities to look for is when you're meeting with a client, if they own a business, uncover if they're a business owner, maximize their estate. So what you want to do is save them taxes. So a lot of people I think all Canadians want to save taxes, number one. So having the opportunity to be able to maximize their estate value and save them income tax and get more to their estate and to their loved ones, and help out their potential business, if they're a sole ownership or if they're a partnership, how they can easily transition the business as well. Also, there's some insurance or some ideas around corporately owned policies and split dollar for critical illness. So if there's a disruption in their business because one of the business owner is ill, find ways to help those situations or help them protect the business owners. Or if they have a key business working a key partner working in their business, what should happen if that person were to become ill or disabled, or if they unfortunately passed away, how can they insure that person to make sure that the business continues as it is today? So hopefully I gave you some ideas, and Jos, I'm excited to introduce Jos today, and she'll be able to walk you through some exciting things for the next 2 hours. So Jos is a tax and estate and financial planning professional who has held senior roles at international accounting firms and one of Canada's largest insurers. At her firm, Resources and Solutions Professional Corporation, Jos provides wealth, tax, and estate planning consultation to individuals, business owners, advisors, organizations, and professionals. She provides independent private business solutions and training focused on wealth concepts, tax efficient strategies, asset protection, and philanthropy. That thing. She is a proud member of the Canadian Association of Gift Planners Conference for Advanced Life Underwriters, Canadian Tax Foundation. Really, Jos is amazing. I can read the bio all day long, but Jos, I want to thank you for all the help you've given my advisors and myself, and we just learned so much from you. Not only are you a great presenter, but you add so much value to our day-to-day roles. So I just want to say thank you so much. So also, she's a triple threat. She uses her skills to provide an objective perspective related to accounting, tax, and estate complexities, legal considerations, and insurance solutions. Without further ado, please welcome Jos. I know there's a round of applause somewhere out there.
Oh, I love rounds of applause. I truly appreciate that. So what I'll do administratively here, logistically, I'm going to have Lynn, if you can switch over our slides. I think we have to do something on your end. And then we will get the show going here.
Great. Thanks, Yas. Let me know if, there we go. Looks great.
Awesome.
So I'll answer any questions throughout as well. So between, we'll look at the questions and help you, and we'll go through that in your break, during your break.
Oh, thank you. I appreciate that. So I appreciate the warm welcome. I appreciate the applause every time. And Lynn is one of the best wholesalers out there. So I hope you take advantage of her knowledge at the end of the day. So my role in terms of with me today is about an hour and 45 minutes or so of talking about tax. We'll talk about it from a business owner perspective, as Lynn alluded to. And thanks, Lynn, for the stats. That really kind of set the scope for there's lots of opportunities out there, and we'll talk about that.
Thanks, Yas.
Yeah, and I want to again thank SSQ and Lynn for this opportunity to speak with you today. SSQ is the one that's going to provide you CE credits. So they're going to provide you 2 of them today. So look for that. People have been asking, Yas, can I get your materials that you're going to talk about? Absolutely. So that'll come your way. So SSQ will facilitate that. So again, great partnership there. At my firm, I'm independent from SSQ, but here's how I operate in my own firm. I help advisors and clients in that whole tax and estate planning world. And again, when you think about having some bench strength to understand those complexities, that's where I sort of help from that consulting standpoint. And then when you think about, well, Yas, there's accountants out there that don't understand insurance or tax and estate planning. I also partner with those individuals to help them. Again, the accountants may be too busy, or they may not have that skill set on the tax and estate planning side or insurance. So again, that's where I help from that standpoint. And then again, I provide workshops and courses and those things like that. And so that's where a lot of people do see me out in the industry. So, again, thank you to SSQ for inviting me here today. All right, we've got a full agenda for you. Here's what we'll talk about. We're going to talk about how business owners pay themselves, right? So again, we'll talk about some salary and dividends. We'll go through the steps that I think are really important, and Lynn alluded to it. We can't just step into just giving our clients just an illustration. And how we then incorporate any financial information at the end of the day, and what to obtain, because there's a whole host of things we can obtain to, help our clients and understand them. And we'll walk through just a quick client example. And my goal is then, once you see the example, I invite you to go talk with Lynn, share how, we can build, or they can build that for you and present it to an accountant or client, etc. As Lynn said, we'll take a break about halfway through. We'll try and facilitate any couple of questions during that break, and then we'll take some at the end as well. So that's what our day looks like. If we think about the business owner, right, and Lynn talked about how many of them are in Canada. The question is, what does that mean? So you may approach Lynn and say, I have a business owner client. And she may say, well, what do you mean by that? What type of structure are we dealing with? Because the tax consequences and who's involved in that looks a lot different based on the type of structure that they have. So here's our first structure. You can set yourself up as a sole proprietor, and that might be you as a broker, where you're self-employed, you have your revenues or commissions and the expenses. And then that net income, you would take that and apply that to your personal tax return, and then you would be taxed on that. As opposed to, I have set up a partnership where I have 2 partners or 3 partners, and we each hold partnership units and share in the partnership income. Don't confuse being a partner with being a shareholder in a corporation. So I have advisors that say to me, well, Yas, these 2 guys, they're partners and whatnot. And I kind of have to stop them there, because now they start talking about a corporation. A corporation's a separate legal tax-paying entity. I would be a shareholder in a corporation. And again, I own those shares, and they can be voting or non-voting based on how the lawyer would structure those shares in terms of what attributes we're going to give to them. That's going to be our focus today. On top of this corporation side, we can have professionals, so i.e. doctors, lawyers, dentists, accountants, real estate agents can be incorporated. And we would define those as professional corporations. So these are people that you may have gone to the dentist, and you saw Dr. Johnson, PC, Dental Corp. Those individuals have interesting attributes themselves. They're high earning people, and they sell services. So they don't sell products like tables and widgets, but their need for insurance is just as great as any other. So I encourage you again to understand what type of business owner you may be dealing with, and the opportunities that we'll explore with corporate insurance or even things like CI or whatnot. So let's start in terms of understanding how a business owner would pay themselves. So we define this, as owner-manager compensation. And we always want to say, well, hey, business owner, how are you paying yourself? How much are you paying yourself? It's a great question to ask. We've been doing these sessions across Canada, and people say, well, what questions should we be asking our business owner clients? Here's one of them. If a business owner said to you, well, you know what, I'm only paying myself $20,000 out of the corporation, they may be leaving $200,000 inside the corporation. So again, is there a corporate insurance opportunity knowing that they're saving amounts inside their corp? You may have a business owner that says, okay, well, I'm paying myself $30,000, but my kids are being paid $30,000, my spouse, etc. So these family members are also being compensated, being paid dividends. Now, that's defined as income splitting, right? So instead of that business owner taking out $200,000, they are splitting that income with other family members. We'll talk about that more. So now we see there's potentially other people in this corporation that we could insure or protect. So this whole idea of owner-manager compensation is a great starting point to understand your clients, to understand, are they savers or are they spending all the money? So you could have a business owner client paying themselves $200,000 out of their corporation, and then they're spending it all. You need to follow the cash. What are they doing with those funds, with that compensation? So again, lots of opportunities for questions when we talk about this topic. Now, if you think about how I can pay myself as a business owner, I can do that a couple of ways. So again, I can pay myself a salary, or I can pay myself dividends. Those are two common ways. And when you think about that, and if you asked an accountant, which one would you pay out to a business owner as a shareholder, their mind goes to tax, meaning it's cheaper, and I'm using air quotes, in terms of it would be cheaper to pay a dividend out to that business owner. And we've seen that because tax rates have changed, etc. And it's because of what's called tax integration. Given that, it's cheaper to pay a dividend. And we've seen that trend, I'll say over the last maybe 10 years. More of your business owners have been being paid dividends rather than salary. Now, if we think of, can a business owner pay themselves salary and dividends? Absolutely. So I always, challenge, the idea of, should we always just think about compensation from a tax perspective? Should we just pay dividends because they're cheaper from a tax perspective? Well, I think if we start to pay ourselves salary or start to ask, our business owner, why aren't you being paid salary? It leads us to this whole idea of financial planning, retirement income, because when we pay ourselves salary, it leads to potentially the idea of retirement income. So I know some of you as advisors do financial plans for your clients. And again, if we look at the potential for retirement income, if I've contributed to CPP, I've paid a salary, T4, that gives me the opportunity to have maybe CPP as a source of retirement income. So I was doing a tax and estate plan, financial plan for a couple, and they'd been paying themselves salary over a number of years. So we were able to say, okay, what's your statement of CPP? Let's add that as a line item to say we don't have to take out money out of the corporation when you retire. We can rely on that CPP amount. If we think about those other business owner clients that have been paying themselves salary over the years, now they have earned income, and that allows them to contribute to things like IPPs, individual pension plans, RRSPs, all those things that gives them income when they stop working. So again, I had another client that was, again, paid themselves salary over a number of years. We were able to look at an IPP solution, get some corporate deductions, all those things to allow for a nice retirement stream going into their, future years. So again, asking about salary or dividends can allow for more opportunities. And again, when you think about the insurance realm, okay, so if I can protect a business owner client or a key person or an employee at a company, I could put in key person insurance. So let's say their salary's $100,000. SSQ has a financial guide that says, we'll give up to 10% or, based on their guide, an insurance policy based on that. Or we protect the business owner with CI or DI, with all those things that an underwriter would say, well, how much T4 income was paid? And I also think salary gives us the opportunity to start thinking about, we can deduct things like childcare expenses and employment expenses, and then, moving expenses and any government programs that are, again, income-based. So just my thought, it's not just about tax. It's much of the bigger picture. And, Lynn had said, I'm a member of the Canadian Tax Foundation, and the accounts are starting to realize that maybe it isn't just about tax. Maybe there's more to think about. So I'm encouraged by, that comment. Start asking the question. Start asking how much, are other family members being paid? All those things where we can say, we can now find some solutions for our clients. We can protect our clients. We can start to figure out, where is the cash going? So it's a good time of year to ask for tax returns, personal tax returns, because we've gone through tax season. It's been a little delayed this year because of the pandemic, but again, clients will usually have them ready. And then you can sort of get a sense of how much salary was paid, how much dividends were paid. Did it look different than last year? So good questions to start asking your clients about. This whole idea of salary versus dividends, remember, a salary is T4 income, it's a corporate deduction, and there is a reasonability test associated with it. So CRA says, okay, if I want to pay someone out of the corporation, let's say it's my son or daughter, and I pay them $100,000, to just do some cleanup around the office or whatever. CRA would, look to say, is that reasonable? You would pay that amount for them to do that type of task. Would you have paid a person that's not related to you that same amount? So there's a reasonability test with salary. In Ontario, our highest marginal tax rate associated with salary is 53.5%. So it's a high rate. The West Coast and the East Coast, again, high rates of tax from a personal standpoint. Middle of the country, much lower in terms of a couple of percentage difference in that perspective. So here we sit. Reasonability test with salary. Is there a reasonability test associated with dividends? Okay, well, that's changed recently. So remember, dividends can only be paid to shareholders of a corporation. They are after tax dollars to paid out, and we'll talk about where we can see that in our financial statements. And we have to remember that now there actually is a reasonability test associated with dividends. And I'll equate that to the new rules under TOSI, tax on split income. TOSI says, if you want to pay that son or daughter that, $30,000 or whatever it is as a shareholder in that corporation or out of a family trust, we will tax them at the highest marginal tax rate unless they meet the certain exemptions that CRA has now stated. So TOSI is a really applicable conversation about owner-manager compensation, because that business owner, like I said, may have been paying themselves $30,000, paying the kids and other people $30,000. Because of TOSI, that may look different as we sort of go into future years, because those kids may not meet the test. So something to think about, something to ask, especially when we see different compensation, let's say from last year, previous year, and now going into 2020 and further. So that's our conversation about owner-manager compensation. Follow the cash, where is it going? And again, your opportunities to talk about this idea of dividends being taxable or tax-free. And I always remind people that we really have two types of dividends. Forget about the non-eligible and eligible. We'll talk about those. But there's two types of dividends upon passing. So let's say, again, if I wanted to extract dollars out of my corporation at time of death, I would want those dividends to be tax-free in nature. In order for them to be tax-free in nature, these are capital dividends. And I want every client to know, I want every advisor to know that capital dividends are the tax-free ones that'll, again, if I think about extracting dollars out of my corporation tax-free, I would want the option or opportunity to pay those tax-free dollars out with capital dividends. So give your clients choice. Start to talk about this idea of extracting value out in terms of dividends at time of death, and the idea of them being taxable or not. In Ontario, if we think about the taxable dividends, like I alluded to, we've got eligible and non-eligible dividends. The eligible dividends are a lower dividend tax rate, so they're about 39%. Non-eligible dividends are about 47%. So it's pretty high if you think about trying to extract that value and paying all that tax, as opposed to the 0% tax rate associated with capital dividends. So we'll talk more about capital dividends. We want to plant the seed now for you to think about how this will now incorporate into the insurance realm. So stay tuned. If we talk about this idea of taxes as a whole, you get a really strong reaction of, oh, I'll be a good Canadian and pay my fair share of tax. Yep. That's hard to find those clients, those individuals out there. Or they say, well, you know what, I don't care about the tax when I die, let's say. It's my kid's problem. Well, I've heard that, unfortunately. But for the most part, if you asked them, do you like CRA and those things like that, they don't. They don't want to give another dime to CRA. So again, when I think about that polar type of client, it'll tell you, is tax liability something for them to consider? And if we have a tax liability at death, how then do we fund it? And we'll talk more about that. Remember, when we talk about corporate tax, personal tax, anyone having a corporation, that corporation generates corporate income, it pays tax on it. And if I want to get money out, like we talked about, I'm going to pay some tax in terms of personal salary or dividends. We'll talk now in terms of shifting our focus to the corporate side and in terms of the different types of corporate income that can be generated inside of a corporation. So I have three types. Let's focus on the first two. In Ontario, if I have less than $500,000 of net income, the corporation would pay a really low rate of tax at 12.2%. So that means if I'm selling, these products, selling tables and chairs, whatever it is, make less than $500,000 of net income, low rate of tax. If I make above $500,000, so that's again our small business limit that we've been talking about, the corporation is taxed at 26.5. Okay, so these are the two tax rates that I'll say most business owners know about, they've maybe talked with their accountant about. That's probably the reason why they incorporated. Pay the low corporate tax rate. But I guarantee the tax that they don't appreciate or talk about a lot is what's called the passive investment income. This is one where you have heard as advisors in terms of if that client has a corporation and let's say they have a GIC in that corporation and it generates interest income, or they have a portfolio and it generates investment income, that is passive investment income. Now, corporations can have this because, again, the business owner may be saving inside their corporation. And again, because they don't have a retirement plan, etc. So they're going to save in their corporation and they think that they're being taxed at that 12% or 26.5%. But instead, that investment income is taxed at 50.17%. Oh, so that's kind of a kick in the teeth when you think about it in terms of that corporation paying a lot of tax when we have passive investment income. Now, here's a couple of comments when we talk about this passive investment income. So again, it can be, rent, royalties, investment income, disposition of policies, a whole host of things that can happen to generate passive investment income. Now, remember, the Department of Finance came out with some new rules that changed what happens with our passive investment income. They basically said, hey, business owner, if you haven't too much investment income, meaning did you generate more than $50,000 of investment income, we will then reduce your small business limit, so that $500,000 that we were talking about, and we'll reduce it by $5 each time you go over $50,000. So you may have heard that rumbling, and it started effective January 1. So the concern then is, wow, okay, we're paying much more tax, and just because the business owner is saving inside their corporation. So you may hear now new terminology based on this change of this passive investment income being defined as adjusted aggregate investment income, AAII. So that's our change that's been happening over the last couple of years. Now here's where we sit in terms of the accountant's mind, in terms of this 50% tax. They may not be, I'll say, concerned about this tax because in their mind, they have something called tax integration, meaning if the corporation pays 50% tax, so that 50.17% tax on investment income, a portion of that investment income, that tax that they paid, gets allocated to a tax account, a notional tax account called RDTOH. Okay. In that RDTOH, that's notional tax account, it's kind of a holding pattern. And as long as the business owner, that shareholder, pays himself a taxable dividend, the corporation is refunded a portion of the tax that it paid. This integration, this tax integration, may be the reason why some of your business owner clients are being paid dividends. Okay, so going back to our conversation about salary versus dividends, they're trying to recover some of the tax that's already been prepaid by the corporation. So again, know the motivation. Is it part of this? Again, it'll help you understand when you're talking with the accountant and for you to understand this whole idea of tax integration and RDTOH. Here's the other side of tax that, again, a lot of business owners don't think about. They don't think about the tax that happens at death. They're too busy thinking about, filing the GST return, getting the information to the accountant, are the employees going to come into work today? How do they increase revenues? All the other stuff. But there is an inherent tax liability on the shares that a business owner would own, and it's that capital gains tax. So let's talk about that. If we think about our client, let's say his name is George, and he owns shares. Let's say he's not married, and he is deemed to dispose of his shares at fair market value at time of death. All right. So when we think about that, let's do a little show of what it would look like in that calculation at time of death on the terminal T1 tax return. So let's assume that George's shares are worth $5 million. We're going to minus the ACB of the shares that he has, and they're probably low, probably around $100, etc. So the ACB is the adjusted cost base of the shares. We can usually find that on our balance sheet in our financial statements, and we'll talk about that later on. Here's our capital gain. I apply the capital gains rate. So remember that 53.5% that we talked about? If I half that, that's where I get to the 26.7%. I just have some BC rates in here showing there because we're trying to do this across the country, but it's pretty close to what's happening in Ontario. If I look at that 26.7% tax on those shares for 2020, George's has a tax bill of over $1.3 million. If I did that calculation for George, a few years ago, tax rates again were about 25% in 2019 and then a little bit lower in previous years. So George may have been your client, a few years ago when he said, you know what? Oh, that tax bill you talked about of maybe 1.1 a few years ago. Okay, I don't want to do anything. I don't want to get insurance, whatever. Well, because the tax rates have gone up just over these recent years, his tax liability at death has also increased. So again, start to do just some draft calculations maybe for your clients to start the conversation. And the biggest thing when we talk about tax liability at death, we can then start talking about the liquidity that's needed at death. Is there liquidity within the client's net worth to fund their tax liability? Or do we need a tax efficient mechanism, like insurance, that can fund the tax liability? Start the conversation. Start talking about this inherent tax liability on George's shares. Now, if we think about George, let's just round the number. Let's assume George's tax liability is $1 million. Well, there's different ways to fund this tax liability, right? We could have him have his executor sell the assets, or he can save for it. The executor could take a loan out, or we can talk about insurance. I want you just to consider the four. I've had clients where they've had a whole bunch of real estate And their idea of funding the tax liability is having the kids sell some of the real estate after dad has passed away to, pay for the tax liability. Okay. That solution involves, okay, so what's the value of those assets? How quickly can you sell those, pieces of real estate? You're going through, this pandemic. How is that going to happen? What's the value? Do you have a will that allows for this type, sale of assets? Do you have a competent executor to do so? Those are the things we need to consider when we talk about selling assets to fund this tax liability and the tax ramifications of selling it. It's not like, oh, I'm going to sell $1 million property and not pay any tax. How about if George saved for that tax liability? I've only come across it once where one client had funds available in his bank account to fund for the potential tax liability. That is rare. It's far in between. This does not happen readily. But George could save. He could save. The question is, what's he going to invest in? What's the tax ramifications of choosing a GIC versus something else? And the question for George is, what's your time horizon to pay for that tax liability? So just a really quick schematic. If the tax liability is $1 million, he starts to save, pay some tax on whatever he saves on. It's going to take him a while. So George, when are you going to pass away? Is there going to be a shortfall in you trying to save? The assets will also grow in value. So it may not be $1 million we're talking about. It could be 1.3 or whatever the amount is. Do you have time, George? Now, there is the option. The estate or someone could take a loan out to fund George's tax liability. Okay, so is TD going to step in and provide a loan? Good question. What's the interest rate going to be? Don't know in 20 years. As an executor, am I going to take the loan out? I wouldn't want to do that. Are the kids, are the beneficiaries? Well, I'll tell you, if there's some sort of litigation or family issues, no one's going to play along. This is the riskier option. When we think about funding a tax liability for a business owner, let's think of insurance as the low risk option. The other ones we talked about, like saving and getting a loan, etc., selling assets, those are higher risk options. They have certainly other tax ramifications and family law issues that need to be considered. Start to do present value calculations of these options. Show them for the client, even show them to the accountant. That's absolutely one of the things that can be done. Think about those options. Tell them about the risk associated with each of those. Now you may say, Yoss, well, it's not going to be $1 million tax liability. There's ways to mitigate it. I've heard of these ways, or the business owner may mention some of these. The accountant themselves may speak to some of these in terms of ways to mitigate the tax. So let's explore some of these. The accountant may say, we're going to take advantage of the spousal rollover. Okay, so a spousal rollover means George, if he was married, could roll the shares over to the spouse. And we could do that without incurring any tax. And we would do that, again, rolling it over at the shares at its cost base. This is tax deferral. Tax deferral means I'm pushing the tax to the ones I love. So again, when we think about this opportunity in the Income Tax Act, it's a great opportunity. But the question is there going to be a spouse? What if this is George's second, third marriage? The question also is, does that spouse have the capacity, i.e., maybe they have Alzheimer's, they have a disability or something that may not warrant having assets being passed on to spouses? I don't think it's always automatic. But again, it's just a tax deferral. The tax will be paid on last death. If I think about some of the other mitigating things like the capital gains exemption. Now, again, your clients may know about this. They can, the capital gains exemption right now is about $883,000. If anyone's in the farming world, it's $1 million. And the shares must qualify in order for the individual to claim the capital gains exemption. Now, it's not automatic. CRA has various tests to say, how long did you own the shares? Was there too much passive assets inside the corporation that may taint that one test that they have? It's not automatic. It's a good conversation to have with the accountant, though, to see if we can purify during his lifetime to eventually claim the capital gains exemption. But again, it's not automatic. A lot of things have to happen in order to claim the capital gains exemption. How about the estate freeze? The estate freeze is a tax transaction where we say we are going to freeze the value of the shares. So George could have had common shares, and he's going to freeze and exchange these shares for preferred shares. And then new common shares could be issued to family trusts or to his children. Okay, so this transaction freezes the value of the shares. Now he has preferred shares, and it freezes the value of the tax liability. It doesn't make the tax go away. It just pushes the tax to the next generation, etc. We could mitigate the tax a little bit more if we did something called a wasting freeze, admittedly, but we have not eliminated the tax. We still have an opportunity to ensure the tax liability on those preferred shares. Lastly, the accountant may implement post-mortem planning, and this is planning that can be done after George dies to save one of the layers of tax. One of the layers of tax comes into play when we talk about double taxation. So George will still have that inherent tax liability on his personal tax return, that T1. But if his family, his estate, his children want the money out of the corporation, there'll be another layer of tax, that dividend tax that we talked about, potentially at 47%. That's where we get double taxation. So the accountant comes in and says, well, we can eliminate one of the layers of tax because of post-mortem planning that could be done. So again, the accountant hasn't eliminated both layers of tax. They may have mitigated or eliminated one. So in any of these examples I gave you, tax could be reduced, admittedly, but it's not a guarantee, and a lot of things have to happen in order for us to say, oh, well, you don't need $1 million of insurance to cover the tax liability. Maybe it's less, but that's fine. There's still opportunities, and given, even if the client does an estate freeze, etc. So there you go. Your opportunities for finding opportunities, I think, are out there. When we talk about corporate taxation and corporate insurance, Lynn kind of gave you a couple of examples, right, in terms of, enhancing the estate and those things like that. Remember, if we have business owners where they have debt inside the corporation, i.e. they went to Scotiabank, they have $2 million of a loan, and you've got maybe 2 shareholders in that corporation, they could have, insurance from SSQ, just simple term insurance to cover the loan if someone passed away. They could continue on with their corporation if the other person's not there, and they don't have to use up CDA. So again, covering debt, really easy corporate business solution. How about key person or buy sell? So we mentioned key person before, remember? Could be 10 times salary. So again, we all know Lynn is a valuable employee of SSQ. We could insure her life to make sure that if something happened to her, we could keep going on to try and find a replacement, those things like that. That's key person. As opposed to buy-sell, whereby, let's say, Lynn has a corporation with somebody else, and she's one shareholder, and the other person's another shareholder, and they each have 50% ownership. We could have insurance on Lynn and also the other shareholder, so that we make sure that, the other shareholder may not have the business acumen like Lynn has, and Lynn wouldn't want to be in business with the other shareholder's family if they pass away. That's the beauty of buy-sell insurance, and we'll talk more about that. We talked about tax liability, right? This whole idea of, yes, you're going to pay tax during your lifetime in different ways, but let's talk about the tax liability at death, and is there liquidity there? We can also think about in corporate insurance in terms of diversifying for our clients. Insurance is an asset class in terms of permanent insurance. That whole idea of, your clients that have too much real estate, or again, they have no other assets besides the corporation and maybe some minimal investments. We need to diversify for these people. It's about building a portfolio that does different things, and the life insurance will bring the liquidity and the tax efficiency within that portfolio. Lastly, for any business owner, the hope and the goal is that either one, they can sell the corporation or sell the company in the future, or they give it to their kids. That's the goal. And not every child will be the next successor, right? They will not be the next business owner for various reasons, i.e. they don't have the business acumen, they may have a disability, they don't live in the country, whatever the reason. We can equalize with insurance to say, okay, these kids or this child will become the new business owner, inherit the shares, those things like that, and we'll equalize the other non-business kids with the insurance. That's good planning. That's good tax planning. Figure out where your clients fit. It could be one or two of these solutions. It could be that they're charitable. We could layer on that in terms of one of the solutions. But I think that there's lots of opportunity to talk about corporate insurance. And again, just knowing some of the tax stuff that we talked about will help build those good corporate cases. So when we think about building a good corporate case, this whole idea of, okay, I want to help this business owner client, I challenge you to lay it out in terms of steps. Lay it out between step 1 and step 2 of getting to know your client from a non-financial standpoint and also from a financial standpoint. What do you know? What do they own? Do they have wills? Then we can talk to them about the type of insurance, where to place it, who should be insured, all those things like that. I had an advisor send me an email saying, I have a business owner client, and we could do split dollar with them. They knew really nothing about they knew nothing about their business owner client. They didn't really know anything about steps 1, 2, and 3. They had already jumped to, this is the type of insurance we're going to do. And what you'll see as we talk about the remainder of our conversation today, that advisor may be missing out on a whole bunch of other insurance opportunities if they didn't go through steps 1, 2, and 3, and they already jumped to step 4. So before we head into the break, I kind of want to give you that idea of get to know your client from a non-financial standpoint. Who are they? What's their concerns? Are they the type of individual concerned about tax? Are they concerned about leaving a legacy for their kids? What's their objectives, right? If we think about the risks that they could be facing, is it things like tax? Is it things like probate tax or EAT in Ontario? Is it the risk that, again, they have a child that has a disability that person needs to be taken care of. What are some of the things that could impact their lives? Is it the bank going to be concerned if that business owner passes away? Is it the other shareholder going to be concerned if that person passes away? And what's your business owner's state of mind? Again, we're kind of in this nice little world right now from a perspective of clients are thinking more about tax and estate planning. They have maybe had more time to think about it. And on top of that, they maybe have thought about their mortality. So again, where do your business owner clients sit? You may still have clients that say, I don't care about it. I'm going to be dead anyway. You will still have those clients. But those clients that are receptive, you got to know who you're dealing with. And from a health perspective, anytime we talk about insurance, we need to know, is there some conditions we should be worried about? Is there a bunch of medications, on the fridge? And again, is there people within that family group that have a health consideration that maybe we can also, provide some insurance for them if that main business owner passes away? Know your client. Go through the steps of 1, 2, and 3. And as we head into the break, what I'll do is invite Lynn back and see if there's any initial questions. We'll take about a 5-minute break for you to have that sip of coffee or whatnot. And again, think about some of the questions that you could start asking your own clients to get to know them. And then again, based on some of the tax concepts we've talked about so far. So Lynn, any pressing questions we should answer before we go into break?
Thanks, Jos. The comments, I've gotten emails and comments saying, wow, best presentation this year they've seen. Great job. Really, it's exciting that people love tax as much as I do, you and I do. Or at least helping Canadians save the taxes, I should say, not actually don't love the tax. That's right. We do have some questions, and I fear they would benefit everyone. So the first question from Mark is, are there any restrictions on those who have professional corporations to also have a holdco?
Great question, Mark. So if I go into each of the professional associations in each of the provinces and also each of the different professions, each profession has their bylaws that say who is allowed to have voting and non-voting shares. So the voting shares always have to be the professional, i.e. the accountant. The non-voting can be family members, trusts, holding companies, etc. You have to go specifically into that association's bylaws to see if they allow for it. Okay. So I'll say, it's a really specific question, but the options and opportunities are out there based on the profession. So great question.
Great, thanks. I'm looking to incorporate CI for a key person where cash built up is to be paid out to the key person on their retirement. What's the best way to do that if possible? That's from Steve.
Yeah, okay. So Steve, if we think about, I can have CI personally or corporately. There's our first thing. When people say, oh, gee, Jos, should I have corporate CI? Absolutely. So, if you think about a nice, healthy CI policy, let's say it's $500,000, I don't have to pay the full $500,000 out of the corporation, right? If someone has suffered a critical illness, they could pay themselves minimal salary or dividends and trickle it out. Or they could use some of the funds to help pay for existing rent or whatever it is. So that's the first really, nice, simple option.
Or to pay someone to replace them too, while they're off, right?
Exactly. So many options.
An employee, yeah.
Yeah. So I don't mind corporate insurance, corporate CI insurance. The question is, could you do a split dollar CI? Sure, that option is out there too if you're doing things like ROP. But again, a little bit more complexity. But it could be out there if that person, chooses to have ROP as well. So again, connect with Lynn. She can help you on that front as well.
Great, thanks. Mark has a question. If the business owner or client owns real estate, how much of a tax issue is the recapture of CCA?
Yeah, so if we have that and we've claimed it over the years, right? So the question is, did I depreciate it too much versus claiming too much CCA? There could be that recapture when it's sold. So it's a calculation that you sort of have to do with the accountant to say, if we sell that property, is there sort of additional tax associated with it? So I'll say it's a twofold type of exercise that has to be done.
Great. Thank you. That one, I really needed help on that one, so thanks. It's been a while since I've done that one. A copy of the recording and slides would be appreciated. Excellent presenter delivery, so great job. Super presentation. So the slides we'll be resharing, they'll be accessible in the recording as well. We'll be sending out the links to all the attendees.
That's right. So yeah, so those are some great questions. What we'll do, Lynn, based on that, let's take maybe just 3 minutes, and then we'll have everyone join back, and we'll keep going on our adventure.
Great, thank you.
Thanks.
I will take maybe a few minutes. Whoever is not tuned, who are still tuned in, just to talk about SSQ for a second anyway, and just talk about our universal life, how it fits nicely to protect business owners. And we do have a fantastic CI. So when it comes to our universal life, our premium for the YRT is some of the lowest premiums in the industry. I've gone head to head, customizing plans, comparing to whole life. I use life design analysis. I've been able to give some great advice and help some advisors win some cases over, to be able to take it to the accountant, for the client to be able to take to the accountant, and have a really good discussion between yourself and your business owner. Also, as Yas mentioned, on the critical illness insurance policies, we do have an enhanced policy, and we also have basic. So for the enhanced policy, what I love about RCI is it's competitively priced, number one, but there's so many benefits that are free to your clients. And I just think it's such a great opportunity what we can offer someone who's going through, when you think about it, we're protecting them from a critical illness, but if they do have an illness and they do have to make a claim, or just having that protection for them and having the enhanced, it covers 25 illnesses for adults and 28 illnesses for children. And that even includes autism for children. Over and above on the enhanced, so say someone chose a $50,000 life insurance policy, and typically it has to be life-threatening cancer when there's a claim. So we offer 10% over and above that policy for a stage 1 breast cancer, or melanoma, and stage 1 prostate cancer. So even though stage 1 isn't life-threatening, they may not be able to get the full $50,000 paid out. Typically other companies too wouldn't pay out on that. But we offer 10% over and above that. So they'd have on a $50,000 policy, if they unfortunately did suffer from stage 1 breast cancer, or stage 1 prostate cancer, or melanoma, we could advance $5,000, and that does not deduct from that face amount. So if they do take the enhanced policy, or if they take the CI rider that's added on top of a CI, on top of a life insurance policy, the client has, I'm just talking about Yas, about our CI and the free benefits on our CI. So if someone has life insurance policy with us and they add the CI rider on, or if they take the enhanced CI, what we do is we offer them $750 a year towards psychological services, so counseling. If they have a traumatic event, they can have counseling, especially with the mental illness in Canada. I personally believe that is such a great addition to someone's, maybe their EAP, like their employee benefits program. Over and above that, that's for free, offered just by having a policy with us. They don't have to be ill. They just have that as a free benefit. They also have transportation to and from the hospital if they're having treatments at a hospital. We'll provide transportation to and from the hospital up to 40 miles from their home. Well, that's a miles. Whatever the kilometers would be, I should calculate that out. And they also have access to 2 hours free for lawyers. So we would have a lawyer if they need advice, legal advice from a lawyer for family law or real estate law or estate planning. We offer 2 hours for free. And that's just by having a enhanced policy with us or a CI rider. And then on the Universal Life, you either choose T100 or the YRT, and they're very competitive. And again, there's a lot of little things that are a great addition to having on our platform with our Universal Life and our insurance and our CI. So we have some great, we also have disability riders for business owners to pay debts. So something to think about, and hopefully that will, there's so much going on with SSQ and great things that we offer that until people listen to our presentations or talk one-on-one, they don't know all those free benefits that are offered to their clients. So back to you.
Oh, that's great, Lynn. And yeah, and part of what their value add is inviting people like me to hopefully then say, let's think about helping our business owner clients. So again, if I know those riders and all those options are available on CI front, you need to have those attributes shared with people. So
yes.
Thanks.
Do you have time for a couple more questions, or should we keep going?
We might have to keep going,
Okay.
but we'll definitely save room at the end.
It just is, the one question is, do you have a sample split dollar agreement to work with for a CI case?
Yeah, I know some of the insurance companies do have that. I always just say it's a template, but again, work with the lawyers to say, okay, if we need to amend things, absolutely. But they're just templates, but I don't have one that I personally give out.
Okay, thank you.
You're welcome. So let's go back to our conversation. If I think about this idea of getting to know your client, who's who in the zoo, let's talk about Tom and Nina. If Tom and Nina are your clients, I mean, a good question here is do you just know Tom? Do you just know both of them? The question is, do they have kids? We'll talk about that. So I always say, let's split up our time with our client to get to know them personally and corporately. Because again, we want to know those objectives, those concerns, those things like that. First and foremost, we need to know, are we truly in a marriage relationship or a marriage-like relationship or a common law relationship? Completely different family law issues. Is this a second or third marriage for Tom and Nina? Are these kids the same, out of the same marriage? All these things like that. Talk about, again, that spousal rollover we talked about. Do we have to, again, equalize or give assets differently to other people and not to the spouse? When we think about children, again, do these kids live in Canada? Again, do they have a disability? Do they have a substance abuse problem? The whole gamut. We just sort of need to know, do we need to provide some other type of insurance or protection or something given the family unit? We have to start asking some harder questions. On the corporate side, we know that they're savers, okay? So we're going to see that as we look at their net worth statement. Would they like real estate? Again, that's an opportunity when we talk about insurance and funding the tax liability. They don't like tax. So again, that's a good thing to know. We also know that there is another shareholder involved in the mix. We got to account for that. What's the risk associated with this? And again, what's the existing insurance they have in place? It looks like they don't have any. But if you have clients that have existing insurance already, it may give you an idea that, oh, they like insurance or receptive to it. We then may have to change it or replace it, who knows? But again, know where you sit personally and corporately. If I think about this whole idea of knowing your client personally and corporately, we want to know, is this a corporation that both Nina and Tom are involved with? Again, it seems like that, Nina's not involved in the operations. The concern is if something happened to Tom, that they'd want liquidity on his passing. They're concerned about the tax liability on second death. So again, that's another consideration there. They do have a will. Now, again, most wills in Canada say, I give to my spouse. There might be some spousal trusts in there, testamentary trusts. They're good to get. Then we know how the estate will be distributed. Corporately, we have an organizational chart and we find out there's a holding company. We'll talk about that. We don't think there's a shareholder agreement though with the other shareholder. So we'll talk about that risk. And again, the spouses don't have the financial acumen to take over the operating company should one of the shareholders pass away. We can see some potential issues here, some solutions we could provide in terms of insurance to close the gap for Tom and Nina's situation. Let's start with, again, that whole idea of building the case. We know more now about Tom and Nina, what some of their concerns, what their family dynamic looks like, etc. Let's jump to the financial side. The financial side of building that corporate case is so key. And maybe that's why you're here today, to get some of that knowledge amped up. And again, it's not, that information always isn't readily available. And how do you package things together for the underwriter and making a good solution to present maybe to the accountant? Let's talk about the will first. We said that's in our step 2 in terms of gathering some information. Not every client will have a will. If they don't have a will, we have to go through our estate legislation that says if you have a spouse and children, now we've got a division of assets that look a lot differently than giving it just to the spouse. The will dictate how the estate will be distributed. It will dictate who is the beneficiaries. It will outline potentially some intentions like charitable giving, whatever. If we have, second marriages or whatnot, it would outline, again, will the first spouse get something? Will they not? Etc. You may also find some of your business owner clients may have multiple wills or dual wills. And it may be for various reasons. The first one may be because they've got assets in another foreign jurisdiction, a whole other lovely topic. The other reason may be because, again, if I own shares of a corporation, those are exposed to probate or EAT in terms of time of death. So again, I may have a will that addresses my corporate shares and a separate personal will that deals with my personal assets like my house and all those other things. Recently, we've had a case, the Milne case, M-I-L-N-E, out of Ontario, that addressed that. So again, good drafting is important by the lawyer whenever we consider having multiple wills for your clients. So again, does your client have a will, and is there insurance opportunities when we consider taking care of the beneficiaries, etc. On that financial side, we know about Tom and Nina personally and business-wise, but from a net worth standpoint, we want to also break that out as well for them. Find out, what do they own? Who do they owe? I gave a really quick example here of what it could look like. I always break it out between the personal assets, like I said. So they've got a home, they have some other real estate, and we identified that in our first step. And they have some investments. On the business side, we'd heard that they have a holding company. And again, they have corporate investments in there. So roughly about $2 million. And then they have their main operating business. So again, break it out. We'll talk about how we then, sift through some of the more opportunities whenever we get a net worth statement. When we think about this net worth statement, and we talk about, there's some couple of corporations, we need to find out more about these corporations, meaning who owns what. That gives us the opportunity to ask the client for the corporate structure, the organizational chart. Who owns what? We know there's a holding company. We know there's an operating company. What does that look like? The accountant is usually the one that has this corporate structure. Now, Tom may have written it out on a napkin for you, but again, we want to make sure that it's right. We've confirmed it. And again, the accountant is usually the keeper of the document. Let's talk about corporate structures a little bit. Now, we can just have one operating company or whatever, and again, one shareholder. But again, you have to start asking the questions of, oh, is there other shareholders? What's the risk if this person dies? Is the spouse involved in the business or not? Again, whenever you have one company or more, if you have more shareholders, it just allows you to ask for more or to ask more questions. Now, some of your clients may say, well, Jos, I have a trust. Everything's taken care of. My accountant has done everything for me. I'm so happy with them. I think we've done an estate freeze. We don't need to talk about insurance or planning, etc. Let's go back to our estate freeze corporate structure. Remember when we talked about, George having, an estate freeze done, he could have frozen his shares for the preferred shares, and that's what he owns. And then new common shares were issued to the family trust. So instead of giving and issuing the shares directly to the son or whoever, the family trust is now the new shareholder in our structure. And when we think about a trust in this circumstance, it's an inter vivos trust, meaning it's a trust as a living trust during our lifetime, as opposed to a trust that we would have on a testamentary basis. Now, a trust is really just a relationship. A relationship is not a corporate separate entity. It can be seen as a conduit. So again, if I make some money down in my corporation, I can take some excess cash or whatnot, pay a dividend up to the family trust, and then pay it out to various beneficiaries. All right. I have to be concerned about TOSI under that circumstance. Again, that always plays a factor. And also, I could have family members claim the capital gains exemption if we happen to sell the operation. Okay. But like I said, it doesn't solve the tax issue. It doesn't get away from those preferred shares that business owner may still have. A family trust may mitigate some tax. It may provide some protection. It may be part of a succession plan. But again, liquidity still needs to be addressed. Even though you may have your client or the accountant talk about estate freezes, there's still opportunities to talk about insuring the tax liability, insuring other members of the corporation, etc., etc. Don't be stuck by the estate freeze and the mention of trusts. Let's go back to Tom and Nina then. In terms of their corporate structure, we said that they have a holding company. Now, the holding company structure can look 10 different ways, to be honest. I just gave you one example what it looked like. So again, why do people set up holding companies? Oh, again, it could be seen as creditor protection. So again, I move excess cash up to the holding company via an inter-corporate dividend. And I can start to save in there. I have some investments in there like Tom and Nina. And again, we hope they grow, etc. Or I could have real estate in there, etc. Okay, so based on this holding company, I see it as a way to hold or assets away from the operating company. But it also could be seen as holding shares in the operating company, like a parent company. That's hence, I'll say, the term of where it sort of comes from. Now, if we said that there's another shareholder involved. Okay, so who is this person? Are they related? Are they younger than Tom, older? What's the circumstance there? We need to know some things about this individual as well. So again, whenever you get the corporate structure, it should then probe you for some more questions that you should be asking. So again, whenever you have things like holding companies, it again allows us to talk about, is there some passive investment income in there? Yeah. It's a high rate of tax, over 50%. Can we solve that or mitigate that with life insurance? Yes. And whenever we have holding companies and we try and extract the value out of those, we go back to our conversation about taxable dividends or tax-free ones. That's what corporate insurance can do. So again, ask about holding companies, what's inside the holding company, and then again, it may lead you to where's our corporate insurance opportunity from that perspective. All right, once we saw that corporate structure, we saw that there was that other shareholder there. Why Tom and this other shareholder don't have a shareholder agreement could be for various reasons. It could be that, oh, well, they're related, right? They could be two brothers, and their philosophy is, oh, we don't need one. We love each other. Nothing could go wrong. Or you may have the thing where Tom says, oh, we're just too busy. Yeah, we'll deal with it next year. Next year goes by, another year goes by, nothing's done. There could be a whole host of reasons why there's no shareholder agreement. The shareholder agreement is drafted by the lawyers, right? So when we think about the importance of having a shareholder agreement, I think it addresses a number of things, or it should address a number of things, different events that could happen. So we have various clauses within this shareholder agreement or buy-sell agreement that outlines what happens if Tom passes away, what happens if he becomes disabled. It can address things like retirement, what happens to the value of the shares and the sale of the shares upon retirement, or if he becomes a divorce with Nina, all these things like that. And what happens if him and the other shareholder just don't like each other anymore? It provides the what ifs. It provides what happens to these shares once they're no longer there. Again, especially when we think about death. If we think about these shareholder agreements, they act as a way to say, you know what, if you do pass away, then we don't have other family members or spouses part of the picture when you don't want them to be. So it almost acts like a business will, doesn't it? This is aside from the multiple will discussion we had before. This is a separate document that says what happens upon these certain events. So again, think about, do your clients have a shareholder agreement? Start the conversation, because we know liquidity is needed when we talk about other shareholders involved in a corporation. We'll address it one more time as we continue. So on that same note, we saw a will. We know that there's no shareholder agreement. We have now a corporate structure. We have a bigger picture on that. We talked about the owner-manager compensation before. I always say, like I said, get the tax return. It gives you an idea of how much money is being flushed out of the corporations. So let's take a really quick example of what a personal tax return could look like, what we could look for. So remember, when we have T4 or salary income, that's our first line item, right? That line 101. Any type of sort of retirement income, as we know, under CPP, RSP, OAS, falls under the middle of our return there. And if, one of the shareholders had paid out dividends, they would receive that under 120. So we can see here that this business owner has been paid $150,000, $414,000 of salary and dividends. So again, it gives us an indication of the healthiness and the cash that's been available in that corporation. So what did that shareholder do with the cash? Did they spend it all? Did they spend it on their kids, or did they save it? Did they use it to buy the real estate? And whenever we have real estate, let's look for rental income. So again, that's in our line 126. And again, if the business owner wasn't incorporated, we would show that income on a net basis on line 135. Start to gather the tax return. It kind of gives you a sense of where did the cash go. How much of a going concern, how much cash was available in the corporation. In that corporation, remember, probably the SSQ underwriter will probably want to see a set of financial statements for corporate insurance. Financial statements are important because, again, they give you a sense of what's going on. It gives you a sense based on the set of financial statements that you could be receiving, that they are broken out on a balance sheet, an income statement, a statement of cash flow, and maybe some notes. Notes to a financial statement talk about who the loan is with. It may talk about related parties. It may give you a depreciation schedule of the buildings, etc. Our focus today will just be on the balance sheet and income statement. You may see these just in your client, just giving you a set of QuickBooks statements. So let's talk about the balance sheet first and the things that I look for. When we think about getting a set of financial statements and that balance sheet, it's a snapshot at a given point in time. It'll outline the assets and the liabilities and the shareholder equity at, let's say, December 31. And we as accountants like to have our balance sheets balanced. So the assets will equal the liabilities and shareholder equity. There's no change in that. We've always had that model. So let's look at a set of financial statements. We're going to break it out between our top half in terms of assets. We'll focus then on the liabilities and the shareholder equity. The first two comments that I have about a set of financial statements and balance sheet. You may not have to ask for 2 sets of years of financials because based on the sophistication of the client, they already may have that already in their set, year 1, year 2. So that's a good thing. It saves you time. The second point is the year end of the corporation does not have to be December 31. So again, don't be, confused by that, just set January 31 date. So when we think about getting a balance sheet, the question is, what should we be looking for? Where can we find some insurance opportunities? Well, the first thing I look for is their cash. Is it redundant cash? Is it cash sitting on the sidelines? Is it cash that could be deployed with insurance premiums? Is it cash that should be invested? Whatever. Investments, we'll talk more about that. And we could look for things like related parties, meaning, maybe Tom owns the one company and he also controls the other company. Those two companies would be related for tax purposes. So we want to say, well, should we have insurance in that company as well? So things to look for. Let's focus then on the asset side of our balance sheet. I've just blown it up in terms of, here's our assets, here's some cash. We can see there's some cash and term deposits, roughly about $409,000. For me, that's a positive. It shows that, again, some cash, it can sit on the sidelines. Could it be used for insurance premiums? Possibly. Who knows? I'm not concerned about accounts receivable and inventory. Inventory only gives me a sense that they're selling something. We mentioned advances to related companies, so there is some type of other company. We should maybe look to the notes, maybe ask more questions of Tom. And again, we'll talk about investments and we'll also talk about capital assets whenever we see those line items in a balance sheet. So in that balance sheet, if we see things like investments, I can have investments in the holdco, like Tom has, or I can have it in the operating company. Again, when we think about having investments, we also have to think about those passive investment rules that we talked about before. Is it generating too much? Is it hurting our small business limit? Those things like that. We talked about, if the shareholder wants to claim the capital gains exemption and we have too much investments, that may impede on trying to claim that capital gains exemption either during our lifetime or for the at time of death. I mentioned to you, this is a conversation to have with the accountant, see if, we need to purify or if that's being considered. And again, is claiming the capital gains exemption an opportunity in the future or at time of death? When we think about the investments themselves, if they're GICs versus, RBC stock or whatever it is, it gives us a sense of the risk profile that the client would have. Again, maybe it's a more risk adverse client that has the GIC versus, again, the client that has more stock, etc. Now you've got a better sense then perhaps of your client, going back to who are they? So that's investments. That's how I view them. The second question then is about the balance sheet when we see a line item called capital assets or property, plant, and equipment. This is usually where we see the land and the buildings, the computers, those types of assets that again are recorded at book value. They're recorded at cost and depreciated. They are not recorded at fair market value. So again, corporation may have purchased the building or asset for $200,000. Now it's worth $2 million. The $2 million does not get recorded on the balance sheet. So again, when you see those types of assets, the company, you may think, well, it doesn't have much value, but the fair market value has now increased because we've got a $2 million building inside the corp. So again, do we need insurance to then again provide some liquidity? Have a look. Cash, investments, all those good things whenever we talk about the balance sheet. If we talk about liabilities, remember when we talked about our opportunities or considerations for corporate insurance? If we have debt, we want to make sure it's insured. Simple term insurance can take care of that. If we think about the shareholder equity side of the balance sheet, there's two kind of things to look for. The capital stock could also be seen as the common shares. Remember how we said there was ACB that we would look at in terms of calculating the capital gain. So fair market value minus ACB. We would see that under the capital stock. So again, we can see in this situation, it's quite low, much like we saw in George's situation. The retained earnings, great conversation piece. We can see here that's 1.6 million. All right, so based on that, I always get the question, oh, well, retained earnings, it's cash, right, Jos? Isn't it? It's cash. Well, it's not cash. Retained earnings is not cash, and I want to show you that retained earnings is an accumulation of what's going on in the corporation. So here's the sort of calculation of how retained earnings sits. If I start my company off, the retained earnings are zero. That's my beginning retained earnings balance. If I have net income or net loss, I either add or subtract that amount from that balance. If I pay myself dividends out of the corporation as a shareholder, we would minus there. So again, when we talk about dividends being after tax, now we can see the flow. And that gets us to the retained earnings ending. Retained earnings is not cash. It may give us an indication there was cash to push out some dividends. Yeah. But again, be cognizant of the language you're using. So here's our accumulation in terms of retained earnings. So that's our balance sheet. There's a whole host of things you can look for. And when we think about getting a set of income statement or the income statement, it's easier for us to understand. In our minds, we made so much revenue, so much sales, and we spent it all in terms of expenses, right? Rent, utilities, employee salary. This is where we can find that salary to help talk about, owner manager compensation, etc. This is where we come up with net income for accounting purposes. So again, look for some of those line items, like again, like I said, salary, etc. Now, that's financial statements. Things to look for, opportunities. The question is, are you getting the corporate tax return, the T2? Maybe not. You may not be, looking to get them because of various reasons. The client normally doesn't keep them handy. They're usually sitting with the accountant. Lots of line items, lots of pages, lots of numbers. Okay, so let's see what we can decipher out of a corporate tax return that may help us. It gives us a sense of what's the corporate tax rates we're dealing with. So again, is it 50% tax? Is it 12% tax? It's good to know. It gives us a sense of who the shareholders are, the percentages that they own, if we look at Schedule 50 within that tax return. So it will confirm, oh, well, Tom may have said, well, I think, the other shareholder owns 40%. I'm not sure. You know what? The tax return will also confirm that. Okay. We can also see if there's any related or associated companies for tax purposes. So usually holding companies are associated companies. So again, we may see Tom's holding company there, and we would see that under Schedule 9. We would also see that RDTOH balance. We now have two kinds of RDTOH that got implemented by the Department of Finance. So we can now see, is the balance $2 million? And that's probably why the accountant's looking to maybe pay dividends. We will also see the CDA balance. We will see this as a notional tax account, just like RDTOH. And again, we'll talk about the CDA balance and CDA and how we trigger it, especially when we talk about corporate insurance. So there's our corporate tax return. It helps. So now you may say, well, how does the financial statements tie to corporate tax returns? If we go back to our income statement, the revenue minus expenses, I get to net income for accounting purposes. Okay, so there's our X. We then take that number and use that as a starting point for our corporate tax return, our T2, for us to make then adjustments, additions or subtractions, based on amortization and other things. Now, people say to me, well, Yas, is insurance deductible? My client bought it up, they want to know, etc. So remember, if I look to that answer, insurance premiums are not deductible for income tax purposes. So what do I mean by that? I just said that I take my net income for accounting purposes or per my financial statements. Here's my starting number. I add or subtract various line items. And again, if I have charitable donations inside the corp, the insurance premiums are then added back on our corporate tax return. So we can expense them on the financial statements, but again, it's non-deductible for income tax purposes to get to our net income, in which we pay tax on. So here's my closing comment about life insurance being deductible or not. Do you need to be concerned about it? Don't be concerned. You're using cheaper corporate dollars to fund the policy. You're using the 12.2% dollars to fund it. Again, when we think about can we deduct, a portion of the insurance premiums and all those things like that, yeah, based on a leveraging scenario, under limited circumstances, I have to meet the criteria that CRA lays out in the Income Tax Act. Absolutely. But again, they're not deductible, and that's okay. We're still using cheaper corporate dollars to fund the premiums. So here's where we sit. We have an opportunity to get some information to know our clients financially. getting that corporate structure, what do the financial statements look like, and then tax returns either personally or corporately. The accountant's the one that has them usually. You need to outline to the accountant why you want, that financial information. Outline, maybe you're doing some financial planning for your clients. Maybe you're looking at trying to address the potential tax liability at death. Come up with a reason. You need one to, again, partner with the accountant to say, we're trying to do some planning for the client. We'd like your help on that as well. So think about some of the things we talked about in terms of financial wise, what to get, etc. Especially when we're building a corporate case. The next 2 slides outline for you some of the things we talked about, why we would get some of those documents, what kind of information can we extract from there. So remember, our tax returns give us a sense of tax rates, how much money is being flushed out, how much then again tax is paid on that. Is there charitable intentions? The wills obviously dictate who gets what, and then what's the tax implication? The net worth statement, we'll focus more on that because I think it's an important thing to gather. Corporate structure, we saw it can look like a whole host of things, but again, it gives us a sense of, are there other shareholders? What assets are inside those boxes? And again, are some of those boxes going to be there at time of death or be sold? The shareholder agreement, important document, independent. It takes care and mitigates some of the risk associated with owning shares and what happens to them. Financial statements, as we saw, provide a glimpse of, is there cash available? How long has this company been around? Are there large assets in there like buildings? And if we have trusts, that's okay. We want to maybe get a copy of the trust agreement or trust deed to see who the beneficiaries are, when was the trust implemented. And again, if there has been things like an estate freeze, again, there could be a planning memo that's been done by the accountant to give us a sense of how much of the value of preferred shares that the client has. And again, can that now be insured? So again, think about some of these things you could be obtaining to get a better financial picture of your client situation. So again, who's your client? How are they paying themselves? What does the net worth look like? All the financial side helps us then, let's try and build some type of analysis for our clients. And that may mean going back to our net worth statement. It may mean going back and having a discussion with Tom and Nina and saying, you know what, let's have a little look at what could happen with your assets if both of you passed away. And so you could go through the exercise to say, okay, based on these assets, is there a tax exposure to them? Meaning, again, on our principal residence, probably no tax. Again, there has been rumbling of change, but we'll assume there's no tax on death. The other real estate, yeah, possibly. Registered investments, non-registered investments, yes. Those shares that we talked about, there will be, and we saw just a quick calculation on that. That's just the one layer of tax that we have to consider. The other we have to consider is probate or EAT in Ontario, meaning anything that falls into the estate gets exposed to that 1.5% tax. It's a tax in which, again, liquidity is needed for it. And if we want to do some planning to maybe mitigate that tax, that can also be done. But we also have to consider family law considerations, especially when we start putting assets in joint ownership or whatever. Now, we may have privacy and control issues if we try and give assets away during our lifetime. So we want to know Tom and Nina's intentions about doing that. And then finally, whenever we have other shareholders, other parties, is there a risk right? If some of them passes away, if they become bankrupt, whatever the situation, it's an exposure that we have to consider in our whole conversation for Tom and Nina. So again, fill out some columns. Do the exercise for you and your own family. And again, maybe those clients like Tom and Nina. What I think about that net worth statement, it helps you realize and helps the client realize what assets will be going to certain individuals. Do we have the ability for things like rollovers that we talked about? If this wasn't their first marriage, is Nina going to receive assets, or are the children? And what's the tax exposure on death? What's the probate or EAT that the family is exposed to? Do we need some liquidity? So when we think about our step 3, that's part of it, right? It's laying the foundation of what's going to happen to these assets. And then you can just do a calculation that outlines what's the potential tax liability, i.e., list the assets, what's the fair market value, and then what's the adjusted cost base of those to get to that capital gains. Could there be a capital gains exemption? Possibly. So again, the conversation with the accountant. And again, that leads us to the taxable capital gain, which is half. And again, what's the estimated tax liability? Is it the $1 million like we saw back in George's situation? Do the capital gains calculation today for you, your own family, for Tom and Nina, but also do it for what happens in a few years, 5, 10, life expectancy. Is that tax liability $1 million now, and is it going to double? We have to account for that. So again, now we have an idea of how much liquidity is needed for Tom and Nina, just even from a tax liability standpoint. The other side, when we think about insurance, we have to go back to that shareholder agreement that's non-existent. And so what people ask me is, well, Jos, should we have the agreement in place first, then do the insurance? This is just my thought. I need to know if the shareholders are insurable first. That's our phase 1. Then we know that option's on the table. So again, whenever we know that clients are then insurable, we can then implement clauses inside the shareholder agreement that speaks to the insurance. It speaks to the policy number. It speaks to any changes that could be made for the insurance, et cetera, et cetera. It'll also speak to CDA, or it should. So again, that's my thought on sort of the flow or timing of the insurance and the shareholder agreement. Our same discussion about funding a tax liability also applies to funding a buy-sell agreement. This whole idea of a risk. Do we have a secure liquidity contract right there that can fund the shareholder agreement, or does the other shareholder have to go get a loan or pay out Nina over a certain period of time? More risk, more uncertainty. The lawyers will not draft shareholder agreements or buy-sell agreements automatically with insurance. It has to be addressed in the conversations, etc. So again, you can be part of that conversation. So as we think about those steps that we talked about, 1, 2, and 3, if you do some good financial fact finding, you'll know what assets are there. Is there liabilities out there? What kind of cash flow are we dealing with? It allows you to think about, again, am I recommending something the client's not going to be comfortable with? And again, from a competition standpoint, if you haven't shown your due diligence, your fact finding, your solutions, another advisor could come in who has done that and now has given the client comfort and even the accountant comfort. So again, once you understand the financial aspect, it'll again give you indication of, is there liquidity at death? Okay. So think about this. In those steps, don't be like that advisor that just automatically jumped to step 4 and thought of the insurance right away in terms of what it would look like. I think for Tom and Nina, there's a whole host of insurance options for them. Could it be a single life on Tom, where again, they wanted some liquidity there? We could put that in the holding company. We could do that on joint last to die as well. We want to make sure we have buy-sell insurance, so that's another opportunity inside. And then could there be, again, personal policies? Again, if we're extracting cash out of the corporation, maybe that can fund insurance policies for the children, etc. So again, there's a whole host of multiple opportunities, but if we don't go through the steps, we may be missing out on some of those. So I think we all should need a approach or step process whenever we think about corporate insurance and solutions for our clients. So insurance has these lovely tax attributes, right? We know they're tax-free. The death benefit is received tax-free. It's received corporately. SSQ provides that death claim. Again, any growth in the policy is not exposed to tax. And on top of that, it's liquidity. And you heard that language throughout the conversation today. On top of that, we talked about CDA. Whenever we have corporate insurance, this is what a tax account is triggered. Now, I want to just show a really quick example of what we could show Tom and Nina in terms of a plan A versus plan B, just inside their holding company, make it really simple. When I think about corporate insurance and those attributes we talked about, we could show them under plan A that insurance the premiums could be deposited over a number of years. And based on the structure, working with Lynn, it can look like, again, over a number of years, short amount, lifetime, etc. It provides tax shelter growth, and it provides that initial death benefit. And then we can compare that to that holding company that has that exposure to the tax at 50%. If we could keep putting money into it from a cash flow standpoint, we have tax during their lifetime and then for the estate as well. So again, when we think about providing a solution for, a Tom and Nina, Lynn can talk to you about their YRT chassis. Maybe it's a single life on Tom. It provides $1 million, death benefit, and deposits can be made over 15 years for about $25,000 on a overfunded basis. Make it look like whatever you want based on cash flow, etc. So again, if we think about the deposits on the alternative investments, so again, keep putting money away into that holding company, it's exposed to tax. Even that growth that we talked about in terms of, investment income is taxed at that 50%. So what I'm hoping you can do then is, chat with Lynn to show you this in their SSQ software. This is really the corporate wealth note strategy, the corporate estate transfer or bond strategy you may have heard in the marketplace. It just compares the net estate for the insurance solution that's corporately held versus the alternative investment. And it just compares A versus B. And that's how we get to the last column there. Just a little due diligence, just a little way of comparing for the client what the advantage would be from an insurance standpoint. So that the difference really comes down to A and B is because of that CDA account. It's a notional tax account that gets triggered whenever we think about corporate insurance. So let's look at the details that we need. We need to have the ownership as the corporation and the beneficiary as the corporation. So let's say there's a death claim. We said that those monies are received tax-free. We have the accountant trigger the capital dividend account for the death benefit minus the ACB, or the adjusted cost basis of the policy, to trigger that tax account. When we have that tax account triggered or credited, it then allows for tax-free capital dividends to be paid out of the corporation, as long as the accountant files a T2054 election. So, tax-free money in, tax-free money out. So again, the liquidity. This CDA, this notional tax account, is seen as like an apartment building in terms of having different tenants. And when we think about the conversation with the accountant or the client, they may be more familiar with the first tenant that I've outlined there on the left side, meaning you may have that corporate portfolio that Tom has in his holding company, and he's got RBC stock in there or something. And if they sold it for a gain, half of it would be taxable, the other half would be non-taxable. The non-taxable portion goes into the CDA account. All right, so accountant might be more familiar with that because it happens more readily. We can also have the CDA account triggered if we receive capital dividends from, let's say, the operating company over into the holding company. The last tenant, that life insurance, if we have the death benefit minus the ACB, again, looks at when it's most important. It happens at death. So the accountant may not have clients that always have corporate insurance, or again, their clients may not be passing away more readily than these other transactions. So they may not always be familiar with, again, the insurance side of it. And then the capital dividend account is reduced by any capital dividends, those tax-free ones that are paid out the door of the corporation. So again, here's our CDA account. Here's that beautiful notional tax account that allows us to pay those tax-free capital dividends. Like I said, when we started the conversation, give your clients choice. If we're trying to extract value out of the corporation, let's give them the choice of having tax-free dollars being paid out with capital dividends. All we're doing is manufacturing CDA with life insurance at time of death. That's all we're doing. We're providing a financial tool to provide tax efficiency. So give choice about plan A or plan B. Maybe you can show them that corporate wealth note strategy. Give them the choice of taxable dividends versus tax-free ones. Go back to our opportunities we talked about. This whole idea of insuring the debt. We have that shareholder agreement. We need to make sure that Tom's taken care of. We need to make sure that the tax liability is taken care of for Tom and Nina. Maybe we need to equalize for the kids. You've got lots of opportunity when we talk about corporate insurance. So here's where we'll end off my time in terms of this is who I am. I enjoy talking about tax, bringing it together with the insurance side because I do see it as a financial tool, especially on the tax and estate planning standpoint. We gave you a whole breadth of what it looks like. And we could go through a whole advanced tax course. So, Lynn, maybe we'll do that next time. But I want you to get a feel for knowing your client, thinking about the steps, and all the financial side that we could gather to then make some really good recommendations for our clients, especially on a corporate tax and corporate insurance standpoint. So thank you, SSQ. Thank you, Lynn. I'm going to turn it over to you. See if there's any more questions, and then we'll have everyone continue on their day.
Thanks, Yas. Great presentation, and thanks to everyone for your patience. We're right on time, 3:30 now, so thanks for staying tuned right to the end with us. And Yas, again, you did a great job, and I really appreciate all your education and just how you explain it so simply to us. And and keep it. And even sometimes I think some of us, you forget about this part of it, and you just kind of go day to day. And especially through COVID, you don't want to spend a lot of time with people. So I think this really was a great reminder, really, to get back to basics. And so I've got another follow-up presentation, like Jos mentioned, on the corporate wealth note. So that will be on October the 27th. I'll be doing a follow-up. So we'll go through, I can show you how to use our illustration software, and then really dig down, show you some comparisons. What is CDA, how the tax-free capital dividend can be paid out. I'll be doing that October the 27th. I'll be sending that out along with the links for the invite for that. And we do have a couple more questions. So hopefully you don't mind answering these. So great. If a son owns a corporation and his mother is the key person, can he do key person insurance even though she's family?
Yeah, so you certainly can. You have to explain to the underwriter why you would be insuring her. So again, does she provide, is she being paid salary or whatever it is? So it absolutely can be done. Put that in your cover letter. It can be absolutely done, and Lynn can help you with that for sure.
Thanks. There was another question here. Best corporate presentation webinar. That's awesome. Thank you. Emailed in a question. Definitely want a copy of recording. Okay, one more. Just going through them all. So to answer Patrick Chambers, he asked if there's a consolidation of SSQ and the Capital, their product shell. So at this point in time, we're still operating because it's just new. We still need to come up with our brand, our new name. So I would say stay tuned in January. It's more likely that's going to start happening. It's just a lot of work bringing the two companies together. So for now, it's still business as usual, the two companies. Hopefully in January, we'll see some changes. We're excited because that means we're going to have a lot of opportunities to offer more products and enhanced versions. It's exciting for us. So thanks. So the question for you is there a distinction between married and common law unions for the purposes of spousal rollover?
Yeah, for the spousal rollover, I'll say that there isn't, but again, it's just more of a matrimonial or family law issue to say, do they have the same rights, etc. So again, depending on what exposure I'll say, that's what I'm more concerned about from that perspective. Common law gets a little dicey in terms of what they have access to.
Yeah, the rights are a little different when it comes to the Family Law Act, and it depends on the province for sure. So yeah, that's a little bit of a, so there's an application, I think, for that. One more question. It might be another one. So if doing personal and corporately owned insurance, $1 million each, can they get $1 million personal and $1 million corp with each policy falling under the $1 million in underwriting? So I think that's more of that's a Lynn question. I don't think that's for you. That's more about our underwriting on the $1 million for personal and corporation. They're considered separate. So I think that's more of a question for me than for you. Sorry about that.
No worries. It's a good question.
Yeah. And I would like to, what are your thoughts about the possibility of Canadians losing their principal residence exemption? Sorry.
Yeah, no, another great question. I kind of alluded to it before. It's a great tax savings if you think about it. The question then is in everyone's minds, will tax rates go up? Can capital gains rates change? And there has been the idea and tossed around of, can that principal resident exemption be changed, eliminated, etc. I always say with tax, don't be surprised, don't count on things, but it's a what if right now. And if we're looking to have, we've got a $330 billion debt, maybe everything's on the table right now.
You took the words out of my mouth. I was just going to say with the CERB, they're going to have to find a way to make up for that. And I've been saying this, I think, since I started here in 2012 probably even longer, saying to people right now, the EAT is only 1.5%, and it's not being revisited in how many years? 30 years. and they know they have this large debt now. So where are they going to start looking? If they raised it at 0.5%, that'd be a lot of revenue.
Yeah.
If they raised it to 3%, it'd be a lot of revenue. So yeah, we don't know.
Yeah.
And that's why I always say today, you're calculating your financial plan, your estate planning based on today. It's only 1.5%. But like you said, taxes, they know what's guaranteed in life, death and taxes, right? And they know that they're going to go up. They're not going to go start suddenly reducing our tax bills.
I know. And it's an interesting comment about the EAT, because then us as tax practitioners are going, okay, well, you may increase it, but we will find ways to mitigate it and get around it and do planning and all those other things. So we need to come up with solutions about, how we increase tax revenue, and even, I've heard, could the GST change and all those things like that. So tax will affect us no matter what. And we just need to think about some of the planning we should do and bring liquidity in case we do need it.
Yeah, exactly. And, we've seen the importance of insurance through your presentation, how it can help and solve a lot of the situations for a lot of families and business owners. So thank you, Yas. So I think I've gotten through all the questions. If there's anything I missed, I'll certainly go back and try and answer them. I'll stay on for a few more minutes. And again, thanks for staying a little bit longer, everyone, and for tuning in today and learning more. So October 27th, I'll be sending the invite out for my follow-up presentation. So thanks again, Yas. I really appreciate your time. And Stephen, thanks for managing our webinar for us today. So thanks, everyone, and stay safe and healthy. Have a great day. Thanks, Yas.
Thank you.